Welcome to today's Explainer. Let's jump right into a really fascinating global market paradox. Think about this for a second. How on earth can overall demand for a major industrial polymer be totally dull worldwide, yet somehow prices in certain regions are actually climbing? It seems completely backwards, right? Well, today we're breaking down the polycarbonate market for the fourth week of August 2026, and we're going to untangle exactly why this is happening. We'll be looking at some major global shifts, crazy supply chain bottlenecks, and most importantly, what all of this means for your inventory strategy right now. Now, the engine behind all our insights today is Polymer Bazaar. They are the absolute premier source for critical market intelligence, pricing, predictions, and profit strategies in the polymer space. The data we're unpacking comes straight from their latest weekly report and future trend analysis. And honestly, having access to this level of real-time intelligence, that's exactly what separates the businesses that just react to the market from the ones that actually anticipate it. All right. First things first, let's establish our baseline with the foundational metric for the entire global polycarbonate pricing landscape. We're talking about bisphenol A. It's currently sitting right at 9,500 RMB per metric ton. You really just can't understand the price of the finished polymer without tracking this core raw material. This feedstock cost is basically the bedrock that all regional production costs are built on. Keep that number in the back of your mind. It's going to help make sense of the regional pricing fractures we're about to look at. Just look at the stark contrast in this fragmented global reality we're dealing with. Over in the US, the market is behaving exactly as you'd expect during a slow period. Demand is subdued, supply is abundant, and as a result, prices are sitting perfectly stable. Makes sense, right? But then look over at China. Demand there is also low, but production costs have actually gone up. Add to that a really tightened supply because of some specific plant shutdowns, and boom, you have rising ex-works prices. It's essentially a perfect storm where low demand is just being completely overpowered by production and supply constraints. And guys, this creates a massive global ripple effect. Notice how the US sits stable at 107 cents per pound. But check out Europe. The local demand in the European bazaar is practically dead, just incredibly dull. Yet the price has actually ticked up by 9 euros, bringing it to 2,090 euros per metric ton. So why is that? It's because the rising prices in the Asian bazaars are bleeding over and impacting European pricing. It's just a brilliant example of how interconnected these markets really are. A plant shutdown in Asia can literally hike up your purchasing costs in Europe, completely regardless of your own local economic weather. Section 2. Inside the Indian bazaar, and why this is the turning point. Okay, so having mapped out that macro global view, let's zoom in on the micro-reality of the Indian domestic market, because this is where the dynamics start to get highly actionable for us. Let's ground ourselves in the hard numbers first. Spot prices, excluding GST, are currently sitting between 214 to 217 rupees per kilogram in Mumbai. And over in Delhi, it's just slightly higher, hovering between 216 and 219 rupees per kilogram. Now, the main takeaway from this data is that spot prices have remained broadly stable. We're only seeing very minor day-to-day fluctuations. But listen, stability in price definitely does not mean nothing is happening beneath the surface. Beneath that stable price is actually a really tense market contradiction. Activity across domestic outlets has actually improved a bit. Bazaar participants are reporting much better inquiry levels. People are asking questions, people are looking around, but the overall demand remains extremely cautious. Buyers are strictly purchasing for their immediate, need-based requirements. They are completely avoiding building up any sort of inventory. And because of this, domestic inventory levels across several outlets remain super lean, barely keeping trading activities supported. So if buyers are being so careful and keeping these lean inventories, what could possibly go wrong? Well, here's what's flipping the script. A classic logistical nightmare. We're seeing severe delays in vessel arrivals. The lower availability in the Indian domestic market isn't just because of cautious buying anymore. It's being heavily compounded by the fact that global shipping right now is about as predictable as a coin toss. These disruptions are severely restricting the flow of material into the country, which is keeping those domestic inventory levels uncomfortably low. Just listen to this direct quote from the Polymer Bazaar report. Ongoing geopolitical tensions affecting shipping schedules, transit times, and supply chain movements. This is our current reality. It's not just a random slow week at the port. These structural supply chain movements mean that those cautious buyers we just talked about, the ones keeping super lean stocks and only buying for next week, might actually be walking straight into a trap. If you're relying on just-in-time delivery when transit times are this volatile, you are exposing your operations to a massive amount of risk. Which brings us to Section 3, the final verdict and our actionable strategy. We've seen all the data. We've got climbing prices in Asia, we've got rising prices in Europe despite totally dull demand, and we're looking at a tightly constrained, lean inventory environment in India that's only being made worse by shipping delays. So based on this shifting global reality, the definitive, actionable recommendation from Polymer Bazaar is a clear advise to buy. The logic here is super clear and totally data-driven, because we're seeing a slight improvement in domestic buying interest, and that's colliding with constrained, low inventory availability. Open bazaar prices are poised to rise. The limited price movement we've seen so far, that is just a temporary balance. With fewer stocks arriving due to vessel delays, securing your material right now before those spot prices jump is absolutely the most strategic move you can make.
Section 4. Instant Market Access.
Look, in a market where geopolitical tensions can shift shipping schedules literally overnight, you need a way to stay ahead of these rapid, multi-region fluctuations in real time. So here is a quick pro tip on how you can get this intelligence directly in your pocket in under 5 seconds. Polymer Bazaar actually has a 24/7 WhatsApp chatbot. It's amazing. All you do is save the number +91 93746 24365 to your phone contacts, open up WhatsApp, and just send the letters PC. That's it. You'll instantly receive real-time pricing, company price lists, and market forecasts right there in your chat. It's incredibly simple, and it pretty much ensures you never miss a market revision anytime, anywhere.
Which brings us to our final thought for today. We've just seen how a single plant shut down in China and delayed cargo vessel can completely alter regional pricing and availability across the globe. So ask yourself, with global shipping this completely unpredictable right now, is your current, cautious, just-in-time inventory strategy actually leaving your business exposed to a sudden price spike or material shortage? Seriously, think carefully about how lean you can truly afford to be right now. Thanks so much for joining me for this explainer, and we will catch you next time.